Hello everyone, I'm Rohan, your trading guru, and today we are going to dive into a very crucial topic: how to manage and mitigate risk in trading. If you have ever felt anxious about losses in trading, you have come to the right place. I'm here to show you how to effectively manage those risks and trade with more confidence. In video 8, we already started talking about risks, and if you haven't watched it, I suggest you pause this video and go watch it. And before we get started, don't forget to hit the subscribe button. By subscribing, you always stay up to date with my latest tips and strategies to help you become a better trader. Let's face it, trading inherently involves risks. Every choice we make in life, including trading decisions, carries some level of uncertainty. However, we can mitigate these risks through strategic planning and informed decisions. The primary risk in trading is losing money. It's uncomfortable truth, but it's a part of a way. The key is to prepare yourself mentally for those invisible losses. Successful traders understand those loss in part of the journey, and they approach it with a stable mindset. Luckily, there's a tool that acts as a safety net against these risks: risk management. This strategy helps us identify, evaluate, and manage potential risks, ensuring that we don't lose more than we can afford. Think of it as your financial safety net. On Binomo, you can employ several risk management techniques: position sizing, diversification, risk reward ratio. Let's explore these tools in detail to see how they work in practice. We will start with position sizing, which is foundational in managing risk. Position sizing is all about determining how much of your total trading capital to allocate to a single trade. Here's a quick rule: never risk more than 1 to 2% of your total capital on a simple trade. This way, even if a trade goes wrong, you won't deplete your entire account. Let's demonstrate it. I will open my trading chart now. Suppose I have $10,000 in my account. Following the 1 to 2% rule, I will risk only $100 to $200 per trade. As you can see, even if my trade does not go as planned, I still have enough capital to continue trading. By dividing your capital into smaller positions and testing various market conditions, you can fine-tune your strategy and gain valuable insights. Let's look at an example. I'm trading with $500 and set a stop loss at $450. The trade will automatically close if the price dropped to $450. This way, I limit my potential loss to $50, protecting my overall capital. Diversification is another crucial strategy. Instead of putting all my capital into one asset, spread your investment across different assets. This reduces the risk of significant losses if one asset performs poorly. For instance, even though I primarily trade USD pairs, I also diversely into other currency pairs. This way, if one trade doesn't work out, my losses are balanced by gains from other trades. Diversification helps stabilize your returns and minimize the risk of a big loss. Now, let's dive into another crucial aspect of managing trading risks, the risk reward ratio. This concept is fundamental in assessing whether a trade is worth taking based on the potential rewards compared to the risk involved. The risk reward ratio helps you evaluate the trade off between the amount you risk and the amount you stand to gain. The standard recommendation is to aim for a ratio at least 1 to 2. This means that for every unit of risk, you should expect to make at least double that amount in profit. Let me show you how this works in practice. I will set up a trade on Binomo with a risk reward calculator. Suppose I decide to trade with $10,000. My goal is to set a target profit of $20,000. This creates a risk reward ratio of 1 to 2. If I risk $10,000, I aim to make $20,000 in profit. Here's a quick breakdown. Determine your risk. First, decide how much you are willing to lose on a trade. For instance, if you set a stop loss that limits you lose to $5,000, that's your risk. Set your reward. Next, determine how much profit you want to make. If you are targeting a profit of $10,000, you're aiming for 1 to 2 ratio. Calculate the ratio, divide the potential profit by the potential risk. In this example, $10,000 profit divided by $5,000 risk equals to 2 plus 2 to 1 ratio. By maintaining a favorable risk reward ratio, for ensure that your potential gains outweigh your potential losses. This approach helps in managing risks and maximizing profits, even if you encounter a few successful trades. Remember, a well-balanced and a well-managed trade, it's good. Remember, a well-balanced risk-reward ratio is key to long-term trading success. Alright, let's wrap things up by revisiting the main strategies for reducing risks in trading. We have covered several important techniques that can help you trade more safely and effectively. First, position sizing is fundamental. By limiting your risk to just 1 to 2% of your total trading capital per trade, you ensure that a single loss does not devastate your entire account. This approach keeps your trading sustainable even when the market does not go your way. For instance, if you have $10,000 in your trading account, risking 1% means you are only risking $100 on a single trade. This controlled risk exposure allows you to ensure a series of losses without significant depleting your capital, maintaining your ability to trade and recover over time. Next, diversification spreads your risk across different assets. Instead of putting all your capital into one trade, diversify your investment among various currency pairs or markets. This way, if one asset performs poorly, your other investment may still yield profits, balancing out potential losses. Finally, let's not forget the risk ratio reward. This ratio helps you assess the potential profit against the potential risk of a trade. Ideally, aim for a ratio of at least 1 to 2, meaning you risk $1 to potentially earn $2. This ensures that even if you experience a few losses, the gains from successful trades will overweight them. For example, if you enter a trade with a potential loss of $50 and a potential gain of $100, even if you lose 2 out of 3 trades, you still break even. This favorable ratio is critical for long-term trading success. To sum up, mastering these risk management strategies, position sizing, diversification, and maintaining a favorable risk-reward ratio will significantly improve your trading experience and help you navigate the markets with greater confidence. These techniques help you protect your capital, manage your emotions, and make more informed trading decisions. Thank you for joining me today. I'm Rohan, your trading guru. Don't forget to subscribe to my YouTube channel and click the notification button so you won't miss any future video. In the next video, I will show you everything, guys. So thank you very much for being with me. Take care, happy trading, and goodbye.